Accounting fundamentals. Every business, from a corner coffee shop to a multinational corporation, relies on a universal language to understand its own financial pulse. That language is accounting. It's more than just crunching numbers. It's a systematic recording, summarizing, and reporting of financial transactions to provide a clear picture of an entity's economic performance and position. Without it, owners cannot make informed decisions, investors cannot assess risk, and even governments cannot collect taxes fairly. At its core, accounting operates on a simple, yet profound, equation. Imagine everything a business owns: its cash, buildings, equipment, even the money owed to it by customers. These are its assets. But how did the business acquire these assets? Partly through borrowing money owed to banks or suppliers. These are its liabilities. Whatever remains after subtracting liabilities from assets belongs to the owners. This is equity . So, the fundamental principle emerges. Assets must always equal liabilities plus equity. This isn't just a mathematical formula, it represents the financial balance of an organization. Every single transaction, whether buying supplies, making a sale, or paying a bill, must maintain this equilibrium. Understanding this core equation reveals not just what a company has, but where it came from, shaping its financial narrative. Economic principles. Every day, billions of decisions ripple through our world, shaping what we eat, where we live, and how we work. These choices spring from a simple, inescapable fact: resources are limited. We cannot have everything we desire. This scarcity forces us to make trade-offs. If a country builds more roads, it might have fewer funds for school. If you spend your evening watching television, you cannot also learn a new skill. Every decision carries an opportunity cost, the value of the next best alternative you gave up. Understanding these costs changes how we view production and consumption, and why companies compete for our attention. People respond to incentives. A lower price might encourage you to buy more, a higher wage might prompt you to work longer hours. These individual reactions, multiplied across millions, create powerful signals. When we choose to buy a product, we signal its value. When we choose not to, we send a different message. Producers watch these signals, adjusting what they make and how much. This constant interplay of choices, incentives, and costs forms the invisible architecture of our economies. It is not just about money, it is about how societies allocate their ingenuity, time, and effort to satisfy needs and wants. Recognizing these fundamental principles helps us understand everything from the price of a coffee to global trade agreements. The ripple effect of these daily economic decisions shapes the very fabric of our collective future. Quantitative analysis. To build a robust understanding of the world, we frequently shift our focus from abstract concepts to concrete measurement. This is the bedrock of quantitative analysis, a systematic process of gathering numerical data, then employing statistical and mathematical tools to make sense of it all. We quantify everything from population growth to economic shifts, from the spread of a disease to the performance of a global market. It transforms observations into measurable variables, allowing for an objective, data-driven examination of phenomena. This approach lets us move beyond intuition or anecdotal evidence, offering a clear path to understanding. Instead, we scrutinize vast data sets to find hidden trends, reveal powerful correlations, and even identify causal relationships. Quantitative analysis allows us to ask precise questions. How much of an impact does X have on Y? How likely is an event to recur? What is the average change over time? By converting complex phenomena into numbers, we can rigorously test hypotheses, identify underlying mechanisms, and construct predictive models that forecast future scenarios with surprising accuracy. This isn't about guesswork, it's about evidence. Think about climate science. We don't just feel the planet getting warmer. Quantitative methods involve measuring global temperatures for decades, analyzing atmospheric carbon dioxide levels, tracking glacial retreat, and modeling ocean currents with intricate precision. These specific, numerical findings reveal the true scale of change, helping scientists understand past events and project future impacts with significant confidence. Such data becomes an undeniable foundation for global policies and actions. It offers a powerful, yet inherently focused, lens on reality, compelling us to consider not just the patterns it reveals, but also the deeper stories it may not fully encapsulate. Advanced Excel Proficiency. Beyond simple sums and averages, true Excel mastery shifts from data entry to data engineering. Advanced users don't just input numbers, they sculpt them. They transform raw, messy information into structured, actionable insights. This journey often begins with tools like Power Query, which pulls data from disparate sources, cleaning and reshaping it with remarkable efficiency. Think of it as a sophisticated digital sieve, filtering out impurities before the real analysis even starts. Once data is clean, Power Pivot steps in. Here, millions of rows can be loaded, analyzed, and linked, building complex data models that connect different tables. No longer are you confined to flat sheets. You're building relational databases right within Excel, allowing for powerful cross-dataset calculations. Then there are the formulas themselves. Beyond VLOOKUP, techniques like index match or the newer XLOOKUP offer more robust and flexible data retrieval. Dynamic arrays, a recent innovation, allow formulas to spill results across multiple cells, simplifying complex calculations. And for repetitive tasks, Visual Basic for Applications, or VBA, lets users write macros, automating entire workflows, from report generation to custom data manipulations. This isn't just about speed, it's about accuracy, scalability, and turning a spreadsheet into a dynamic analytical engine. It moves Excel from a simple calculator to a powerful business intelligence tool, capable of handling vast datasets and delivering insights that drive critical decisions. The question then becomes, what insights are you missing? Financial modeling. Every significant business decision, from launching a new product to acquiring another company, relies on peering into the future. Financial modeling offers a structured way to do exactly that. It isn't fortune-telling, it's the creation of a sophisticated, dynamic representation of a company's financial performance and position, typically built within a spreadsheet. Analysts construct these models by inputting historical data, alongside a detailed set of assumptions about future operations, sales growth rates, cost structures, capital investments, and financing decisions. These inputs feed intricate formulas that project key financial statements, the income statement, balance sheet, and cash flow statement, often for multiple years into the future. But the real power of financial modeling extends beyond simple projection. It allows for real analysis. What if raw material costs increase by 15%? How would a new factory impact cash flow over the next decade? By adjusting variables, businesses can simulate various scenarios, understand potential impacts, and quantify financial risks and opportunity. These models provide a robust framework for evaluating strategic choices, assessing company valuations, and making informed capital allocation decisions. They force clarity in assumptions, revealing the drivers of value and the sensitivities to change. The output isn't a single definitive answer, but rather a flexible, living tool. It helps clarify the financial implications of different paths forward, moving beyond gut feelings to provide a data-driven basis for critical decisions, showing how today's choices could shape tomorrow's financial reality. Valuation techniques. Understanding a company's true worth is fundamental, whether you are an investor, a funder, or contemplating a merger. This quest to determine intrinsic value relies on several distinct valuation techniques, each offering a different lens through which to view a business. One cornerstone approach is the discounted cash flow, or DCF, method. Here, analysts project a company's future free cash flows, often over 5 to 10 years, and then estimate a terminal value beyond that period. These future cash flows are then discounted back to their present value using a discount rate, typically the weighted average cost of capital. The DCF model is powerful because it's forward-looking, directly linking a company's value to its ability to generate cash. However, its accuracy heavily depends on the precision of those future projections and the chosen discount rate, making it susceptible to assumption. Another widely used method is relative valuation, often called comps. This technique compares a target company to similar businesses, or comparable companies, that have recently been acquired or are publicly traded. Valuation multiples, like price to earnings or enterprise value to EBITDA, are calculated for the comparable companies and then applied to the target. This approach is quick and reflects current market sentiment, but it assumes the market is efficient and that truly comparable companies exist. Finally, asset-based valuation determines worth by summing the fair market value of a company's assets, then subtracting its liability. While less common for thriving operational businesses, it becomes crucial for companies nearing liquidation, others with substantial tangible assets, like real estate firms. No single technique provides a definitive answer. Each carries strengths and weaknesses. Savvy analysts rarely rely on just one method, instead combining several approaches to build a more robust and nuanced picture of value. This triangulation helps reveal where potential biases lie, or where market perception might diverge from fundamental reality. Data Analytics SQL/Python. Data analytics transforms raw numbers into actionable understanding. Imagine a vast reservoir of information: customer purchases, website clicks, sensor readings. Before any insights emerge, this data needs careful handling. This is where SQL and Python become indispensable. SQL, or structured query language, acts as the primary tool for interacting with structured databases. Think of it as a precise librarian. When a business needs to know, for instance, which product sold most in the last quarter, SQL queries the database, efficiently retrieving exactly that specific subset of information. It filters, sorts, and aggregates, preparing the data for deeper examination. Once SQL extracts this initial dataset, Python steps in. Python, with its rich ecosystem of libraries like pandas and NumPy, excels at manipulating, cleaning, and analyzing the retrieved information. It can identify outliers, calculate complex statistics, and combine different data sources. Beyond simple analysis, Python extends to building predictive models, uncovering hidden patterns, and creating sophisticated visualizations. Where SQL efficiently gathers the ingredients, Python performs the intricate cooking, turning those ingredients into a coherent, insightful meal. Together, they form a powerful analytical pipeline. SQL efficiently retrieves data from large databases. Python then processes it, extracts deeper insights, and automates report generation. Businesses apply this to understand market trends, optimize operations, or personalize customer experiences. It is about more than just seeing the numbers, it is about understanding the forces shaping them, and anticipating what comes next. Active communication. Most of us talk every day, exchanging countless words with family, colleagues, and strangers. Yet, beneath this constant chatter, true effective communication remains a surprisingly rare art. It's often misunderstood as simply the ability to articulate thoughts. But the process is far more intricate, a dynamic interplay where meaning is not just transmitted, but actively constructed between individuals. It starts with clarity, of course. A message must be concise and direct, free of ambiguity. But the words themselves form only one layer. The real depth of communication emerges when we consider the entire exchange. This includes the subtle cues, the tilt of a head, the inflection in a voice, a brief pause, signals that often convey more than the explicit language used. These non-verbal elements paint a richer picture, revealing emotions and intentions that words alone might obscure. Equally vital is the receiving end, listening. Active listening is not a passive act. It demands full attention, the conscious effort to understand another person's perspective, without immediately formulating a rebuttal. It means asking clarifying questions, mirroring back what was heard to confirm understanding, and acknowledging feelings. This reciprocal effort transforms a mere monologue into a true dialogue, fostering a shared understanding. When communication breaks down, the consequences are immediate and far-reaching. Projects stall, relationships fray, and critical information goes unheeded. But when it flows effectively, it becomes a powerful catalyst. It builds bridges of understanding, strengthens collaboration, and allows complex ideas to not just spread, but to genuinely resonate. The ability to connect meaningfully, person to person, shapes nearly every outcome in our lives. Strategic networking. Forget the image of frantic handshakes and discarded business cards. Strategic networking isn't about collecting contacts, it's about cultivating meaningful relationships. This isn't a numbers game. It's a precise, deliberate effort to identify and connect with individuals whose expertise or professional journey aligns with your own. It reshapes how you perceive influence, moving beyond positional power to recognize true impact. This strategy begins long before any event. It requires understanding who genuinely inspires you, or whose contributions resonate deeply within your chosen field. Research their work, their public statements, their challenges. When you eventually approach them, it is not with a direct request, but with an offer, an insightful observation, a relevant piece of information, or a genuine desire to understand their perspective. The aim is to build rapport, to establish common ground based on mutual respect and shared interests, not immediate personal gain. Every interaction becomes an opportunity to add value, so listen intently more than you speak. It is about seeking to understand someone else's world, their problems, their aspirations, before introducing your own. This patient, observant approach lays the foundations of trust. And trust, more than any resume or credential, forms the bedrock of any powerful professional alliance. These connections don't simply open doors, they build bridges to collaborative opportunities and unforeseen possibilities. Building this kind of network takes consistent, authentic effort. It demands patience and a willingness to invest without expectation of immediate returns. It transforms fleeting encounters into durable, mutually beneficial partnerships, where the most valuable currency isn't money or a job title, but profound, meaningful connection. This approach fundamentally shifts how opportunities emerge and evolve, not just for you, but for everyone involved. It is an ongoing process that defines a truly resilient career. Critical thinking and problem solving. Every day, we face a deluge of information, news headlines, social media posts, expert opinions. Sorting through this constant stream requires more than passive consumption. It demands critical thinking. This isn't cynicism, it's discernment. It means pausing to ask, is this information credible? Who is presenting it, and what might their agenda be? What evidence supports these claims, or what's missing entirely? We learn to break down complex ideas, examine underlying assumptions, and consider different perspectives, even those we might initially disagree with. This rigorous valuation moves us past knee-jerk reactions, building a more nuanced understanding. This thoughtful approach forms the backbone of effective problem solving. You cannot truly address a challenge until you deeply understand its roots, weigh all contributing factors, and anticipate the consequences of various solutions. A doctor critically evaluates symptoms before diagnosing. An engineer applies critical thought to structural integrity before building. A community leader analyzes diverse needs before proposing policy. Without this deliberate process, solutions often become superficial, addressing symptoms rather than causes. They might even create new, unforeseen problems. The ability to think critically, to dissect a problem with clarity and intellectual honesty, transforms our capacity to act effectively, not just in grand global issues, but in the daily decisions that shape our lives. It is how we move beyond simply reacting to truly understanding and shaping our world. Market understanding. Understanding a market goes beyond simply identifying potential customers. It requires seeing the world through their eyes, recognizing not just what they buy, but why they buy it, and crucially, what problems they struggle with that no existing solution truly solves. Without this deep insight, even brilliant ideas remain just that, ideas, often failing to connect with real-world needs. Companies launch products into a void, guessing at demand, wasting vast resources on offerings nobody truly wanted, or services already perfected by others. True market understanding builds on several pillars. First, it means knowing your prospective customer intimately. This isn't merely age and location, it is understanding their daily routines, their aspirations, their frustrations, and the underlying motivations that drive their choices. Second, it involves a clear map of the competitive landscape. Who are the established players? What are their strengths, their weaknesses, and their blind spot? What gaps do they leave unfilled? Third, successful ventures anticipate market trends. Technology shifts, changing consumer values, new regulations. These forces reshape demand and open new opportunities, or close old ones, sometimes overnight. Gathering this intelligence isn't passive. It demands rigorous research, analyzing sales data, conducting direct interviews, observing user behavior, and monitoring economic indicators. It means constantly listening and adapting. The market is a living entity, always shifting, always evolving. To succeed, businesses must not only grasp its current state, but also project its future trajectory. Those who fail to see these changes risk becoming obsolete, watching as others capitalize on unmet desires and emerging demand. The critical question isn't just what customers need today, but what they will value tomorrow. Ethical conduct isn't merely about following rules, it's about navigating the spaces where rules don't fully reach, or where they clash. It is the compass guiding decisions when the path isn't clear, defining the line between right and wrong not just legally, but morally. Every choice, from an individual's daily interactions to a corporation's global strategy, carries an ethical weight. This weight profoundly impacts reputations, builds or erodes trust, and ultimately shapes the fabric of society itself. Consider the engineer designing a new structure. Their ethical conduct demands not just adherence to safety codes, but an unwavering commitment to public welfare, even when faced with budget pressures or tight deadlines. For journalists, it means reporting facts without bias, protecting sources, and understanding the profound power of their narrative. In medicine, it translates to patient confidentiality and a commitment to do no harm, often in situations with life-altering stakes where the choice is agonizing. But ethical principles are rarely simple black and white. They often exist in shades of grey, presenting dilemmas where competing values collide. Is it ethical to prioritize short-term profit over long-term environmental impact? What responsibilities do technology companies hold for the vast amounts of data they collect, or the information they disseminate globally? These aren't easy questions. The answers often reveal more about our collective values than we'd like to admit. Societies grapple with these choices constantly, codifying them into laws, industry standards, and unspoken social contracts. The pursuit of ethical conduct, then, is an ongoing negotiation, a continuous re-evaluation of our responsibilities to each other, and to the generations that will follow.